Hello, Mint participants. My name is Jacob Gray, and I am the Senior Director of the Wharton Social Impact Initiative, where I focus on impact investing. Wharton is a partner with Bridges Ventures in producing the Mint, as you know. A little on my background: I've spent 14 years as an impact investor. I'm co-founder and a partner of Murex, which is an impact venture capital fund headquartered here in Philadelphia, and we invest in technology-based early-stage companies in education technology and financial services for the poor. My career started as a strategic consultant to high-growth nonprofits. Over the years, I've served as interim CEO of a social impact company in the workforce development sphere. I've done work in domestic microfinance, and I'm co-founder of Good Company Group, which is an accelerator for social enterprise, among other activities. Now, I should make clear that although I am speaking to you as a part of Wharton, and although the Mint is about impact investing, this video is not intended to serve as an academic finance curriculum. I hope that's obvious. The course is intended first and foremost as practical training, experiential, co-curricular education on how to participate in the Mint. To that extent, we will spend very little time on theory and much more on the nuts and bolts of operating a student-involved, in many cases, student-driven impact investment program at your school. With that said, today I'm going to talk to you about deal sourcing. I've broken deal sourcing up actually into 4 segments, which you see listed on the slide ahead of you. Each segment is quite short, so you should be able to watch each easily and separately in a manageable amount of time. So the goal here is by the end of this session, that means all 4 segments, we want you to be able to articulate your investment strategy and your thesis in writing. Then you should be prepared to actually go out and start finding good deals that make sense for you and your team in a fairly rational and thoughtful and efficient manner. And we'll wrap up the session with a few thoughts on how to actually approach entrepreneurs for the first time so that you can do this with some degree of confidence. Now, to keep things from getting unbelievably boring while you listen to me talk, and for some concrete perspective, I have asked some colleagues to join me to comment on the real world of investment strategy and deal sourcing in impact funds. Nancy, will you introduce yourself first, please? Great. So we'll hear from Nancy and Owen and Josh again in a little bit. But first, let's talk about crafting an investment strategy. So what is an investment strategy? It's a framework. Investment strategies provide the framework required for an investor to effectively evaluate transactions and develop an investment thesis. An investment strategy for a fund is essentially how you think about your fund in relationship to all the deals. Your thesis, on the other hand, is how you think about your fund in relationship to individual deals. All right, and what makes a good investment strategy? First, a good investment strategy will be a guide. It's going to be a guide for deal sourcing and for filtering, and both the investigation and evaluation of deals. Second, it's going to address value creation, how your team and your money will create value in a portfolio company. Last, it will be succinct and focused and easy to understand. It will be brief. Why this emphasis on brevity? Because VC, and particularly social impact VC, is a very relationship-driven marketplace. Your best deals will generally be inbound from referrals. So as you network, when you can be very clear and communicate effectively about what you are trying to find, you give others the opportunity to help you. A good investment strategy not only focuses your thinking, so it also drives more high-quality inbound deals. It's that simple. So what makes an effective investment strategy? So the major factors are the deal size, and both the deal size and your investment size, the industry, type of security, the stage, how you're going to plan for follow-on investments, and liquidity, how you expect to exit. So obviously the Mint tournament has decided a lot for you. These are going to be early stage VC deals. The size of the deal the size of your investment is going to be $50,000, and the size of the deal itself will probably be less than $1 million. The security is almost always going to be convertible debt, and follow-ons are going to be out of your control because the deal is being funded by a third-party angel who will theoretically manage their own portfolio. But to the extent that your school already has your own fund, or you are thinking of building one in the future, the intellectual exercise of creating a strategy is valuable. So it's a valuable exercise because it lays the foundation for the rest of your activities. In a very practical way, your diligence will be better if everyone on your team is quite crisp and clear about how you intend to create value. So here are some example strategies. Some were laid out in the deliverable guidance on the website. I'd recommend that you pause on this point if you haven't already to take a look at some of these examples. Funds should leverage their competitive advantages and institutional knowledge when you're determining your focus industry. So some factors for you to consider are absolutely leveraging your university's key strengths. That means what academic or community or research departments are strengths. Does your school or the university have offices or centers that work heavily with companies in a particular industry? Think about your geography. Is the city a major hub? Are there incubators? Are there other community organizations in your geography that cater to a specific industry? And I think all of this is particularly important in a student-run fund. With less experience and less track record than a traditional fund, you really need to be thinking about your strategy in relationship to this target industry. So the next thing to think about is your team. Many funds build strategy around the industry experience and strengths of their team. Some funds don't. For example, Nancy Fund, who's the managing partner of DBL, highly respected, one of the best, really believes in hiring strong investment generalists rather than industry experts. But for school-based funds, I think it's critical that your team members and your school and your geography strengths all work together. Otherwise, you're going to have a very hard time getting any proprietary deal flow. It's going to be hard to win the Mint tournament if your school is essentially looking at exactly the same deals with little differentiation from all the other schools. Plus, you might miss some uniquely talented individuals. I'm going to give you a guess about who's circled in red. So you want to consider the security type as well. As I said before, Mint is going to kind of make up this for you, but there's a self-explanatory kind of primer here. The vast majority of deals you'll see in seed or early stage rounds are convertible debt, converting into preferred equity at a discount to the next round price. And this is simply because investors won't be able to agree on company value with the entrepreneurs, and convertible debt is a nice way to let the company's future performance determine its value. Some basics about stage as you think about strategy. You're going to see deals in the startup or first stage, most likely. Maybe some seed investments. They're very tough to do and even tougher to sell to a third-party investment committee, as you will in the Mint tournament, but it's not impossible. In terms of liquidity events, I think the IPO market still hasn't recovered, so we ought to be thinking about M&A. I guess a good point here is that one of the most powerful ways to leverage your institution strength in your investment strategy is to bring potential M&A partners to the table for portfolio companies. So it's a very real and potentially powerful strategy. And then we'll talk about follow-on strategy just a minute. Take a look here. Again, if you're considering building your own fund, I think the important takeaway here is that because of the powerful dilution involved, many early stage investors consider their earliest investments to be more valuable really just as an option for later rounds. So reserving enough capital for follow-on is really critical. And last, let's talk about value add. Mint teams are all affiliated with very strong business schools and larger, strong university institutions. You have valuable networks and talented people. These companies, at least most of the good ones, will have choices in whose capital they can take. You want to be sure to be very clear and precise in how you discuss the value you're going to add to these companies so that you can help them make the right decision and take your money. But that's enough of me talking. Let's hear from our guests and hear what investment strategy means to them in the real world. So that concludes the investment strategy segment of the 4 deal sourcing videos. Next, you should continue to segment 2, which is investment thesis.